Welcome back to Fast Money. There is an interesting trend appearing in the market in the last few months that has some market watchers believing Bitcoin could actually be a leading indicator for stocks. And if that proves true, the cryptocurrency could actually be sending a warning about the market. Dom Chu's breaking it down from the newsroom. Dom.
That's right, Melissa. On a day when the VIX was trading at its highest levels in over a month and bonds saw a big breakout of sorts, some are looking to Bitcoin as a possible indicator for where stocks are maybe heading next. Now, if you look at this chart, you can maybe make the case that the two are somewhat correlated. I mean, in December, for example, when Bitcoin topped out, the S&P followed suit just a few weeks later. Since then, it looks as though the cryptocurrency has preceded each rally and then drop in the marketplace as well. So is Bitcoin signaling worse times ahead for the broader market? The short answer is nobody really knows, but it's perhaps something that some traders may be looking at. Not a commentary on the legitimacy or investability or tradability of the cryptocurrency, but rather another possible tea leaf as some market participants look towards the divining of the future direction of markets. Depending on which particular price you use, Bitcoin prices are quoted in U.S. dollars, and if they are, they're down roughly 44% since the end of 2017, from around a level of 13,400 and change to just around the 7,500 mark like we see now. There's just way too little robust trading data and participation in the crypto markets over the last few years to really tell. At the same time, there are those out there who make the case that things like Bitcoin and other digital currencies represent alternatives to traditional assets. Would they catch some kind of a safety bid in the event things get more dicey in global stock and bond markets? Of course, all of these arguments come at a time when the very legitimacy of crypto is still very much on the front burner of conversations, Melissa. Back over to you.
All right. Thank you very much, Dom Chu. So you guys were both shaking your heads when Dom had been talking about whether or not this would be a flight to safety trade, a la gold or bonds.
Right. I mean, if you look at the treasuries, look at the 10, that is an enormous move we had today. I don't think that or Bitcoin, you could go into one of those two as a, flight to safety. I'm very, very skeptical of that.
But in terms of the charts,
leading indicator. Let's talk about that. Because what that usually means is, first of all, there's a fundamental correlation. Often you hear about leading indicators as it relates to the economy. So economists would look at confidence indicators. They would look at measures of spending. They would look at things that are going to ultimately lead to an economic reality. We're not seeing that. Obviously, when you talk about Bitcoin, market sentiment, here's what I would agree with. Back in December, when we started to see Bitcoin sell off, that to me was the early signs of a blow-off top in terms of momentum where we got to Jan 26th in markets. Yeah. I think in terms of positioning and positioning towards risk, so I think it's exactly the opposite. I think if markets were tanking here, yes, I think there's a baseline of core investors in crypto, but you can't tell me people would be running for the safe haven of a cryptocurrency here.
All right. Well, our next guest says Bitcoin could be the next fear gauge, and as of one of the largest VIX brokers at the CBOE, you would know a bit about fear. Brian Sutherland is the president of Equity Armor Investments. We simply call him the fear merchant. Others call him Brian. Good to see you, Brian.
Yes. How you doing, Melissa?
So are you increasingly looking at Bitcoin as an indicator?
I am, Melissa, and this is really interesting because the reason why you look at it, when you think about it, Bitcoin is a way for investors to basically move their money off the balance sheets of banks and into their own wallet, essentially storing their money under their pillow in the form of virtual currency. And to do that, why would you do that? Basically, you're worried that banks are going to have some sort of credit risk. And so as credit risk increases, we get more volatility in the market. And when you take a look at it, here's why I'm talking about this credit risk. When you look at the VIX and you determine the VIX maybe is a measure of volatility and fear in the market and a fear of credit, if you want to know where the VIX is going in the next 30 days, look at what Bitcoin did 30 days ago in an investment. If you took $1,000 30 days ago in Bitcoin, it is telling you where the VIX is going. When we overlay the two together, there is huge correlation right now between VIX and Bitcoin 30 days ago, 30 trading days ago. And I think that is starting to measure out credit risk in the market. That's what cryptocurrency is becoming. It's becoming a way to sort of de-risk yourself from credit risk in the banking industry. And it makes a lot of sense that you would take your money off those balance sheets into a cryptocurrency.
But Brian, it's Steve Grasso. Whether you look backwards and see how small that window is when you compare it to the VIX and you say, okay, Bitcoin could be the new VIX, when you look at the horizon that we have to pick from, can't you see anything? If all you have is a hammer, doesn't everything look like a nail? Is there really a correlation? Is this really the new VIX, or is the VIX really just slow to react, being as though we had a traumatic year with VIX volatility in 2018?
I think it's a great question. Is there enough data to really support that, I think is what you're asking. And when I look at it over the last 6 months, that data is supporting that Bitcoin is sort of becoming the new VIX and sort of getting ahead of credit risk in the banking industry. And I think when you look back at it, take a look at Cyprus and some of the European problems that happened in 2010, 2011. There was also at that time a lot of correlation between VIX and volatility that occurred 30 days later, trading days later, and Bitcoin. So there is a little bit more data than the last 6 months. And like I said, I think it makes sense that this is starting to occur, that this is a way for institutions or millions of individual investors to synthetically store their money under their pillow, take your money away off the bank's balance sheet. There's a reason why the banks and some of the big names and some of the big owners in the banking industry are all out talking about against Bitcoin, against cryptocurrencies, because they realize this is going to be an alternative way of storing your money and protecting against fear and volatility in the market. So I think this correlation continues beyond just the last 6 months of data. I think you'll start to see this continually mature going forward over the next year or two.
Brent, let me ask you something. So looking at the VIX today at 17 and change, if what's happening in the world is another potential banking crisis, a la what we saw in 2011 or 12, the VIX was much, much higher then. How does that fit into what you're saying about Bitcoin, or do you think that this VIX today is saying, you know what, this isn't a banking crisis, this is a little blip?
Right. Well, I think that's a great question. If you look at Bitcoin, where it was 30 days ago, selling off from 10,000 now down to 7,500, what that basically is telling me over the next 30 days, all this volatility today may carry on for the next week or two, but then subside. Because let's be honest here, you know, Italy needs the EU. Unlike Great Britain and them exiting the EU, they could sustain on their own. Somewhere with the problems that you're seeing in Italy within that government, I think they'll still need to be in the EU. I think those problems will start to resolve itself. Look, at the Italian bonds are still trading at 1.75%. There's not, you know, the credit risk doesn't seem to be huge there. So I think today is a one-day volatility event, just like we had a spike in Bitcoin back up to 10,000 temporarily a month ago. I think some of this will subside. This will probably make for a good buying opportunity for stocks headed forward over the next 30 days.
All right, Brian, good to see you. Thank you.
Thanks,
Brian
Melissa.
Sutland joining us from Chicago. Guy, what do you make of all this?
The fear merchant, so we call it the merchant of fear.
Yes.
It's interesting. A lot of it's merchant of Venice, Banasario. Remember that? What do I make of all this? I'm not certain. I love correlations. I get it all, but I'm not going to start to put Bitcoin in sort of the volatility index thing just right yet, at least in my opinion. I understand that the charts work now. I got to give it some more time to see if it works.
Haven't we also been talking for the last 2-3 months about how we're waiting for the institutional players to really get into this market, and that that they will be. But to say that they are able to provide any backstop to volatility right now, or that this would be a place where these guys would step in, they're not even in.
Imagine, right now, in one instant, the money in your wallet, checking, or investment accounts could purchase only 1/10 or 1/100th of what it could yesterday. How would your life be affected? Could this even realistically happen? Well, who is in control of your money and how the US dollar works? Not you. Did you decide in 2008 to help bail out large failing banks? Probably not. But your government did. Did you notice how prices rose for gas and food after this? Our crisis was witnessed by the world, by our creditors. Yet our government borrowed more money and the Federal Reserve printed more dollars. All of these events change the value of each dollar you have. At any moment, another event could happen that changes the value of these dollars more dramatically. So how can you protect yourself? You may have been told to store wealth in real estate or gold and silver. These are good places to store wealth, but you cannot buy groceries or goods directly with these assets because they aren't currency. You can't transfer their value easily or efficiently for real-world transactions. There is a form of currency that does not deal in dollars, and that is actually inflation-proof. It is the banker's worst fear.